Hello and welcome to Gold and Silver Assets. It's Sunday, the 31st of May 2020. So first of all, I've got some really good news for you all. I went shopping for a microphone the other day, and when I went there was only one left in the shop, but thankfully it was a good one, so I snapped it up. And I know how annoying it can be listening to poor quality audio, so hopefully this should be a huge improvement for you all. Now, in recent weeks, we've had quite a few interesting questions and comments regarding the relationship between gold and the general stock market. And so today I thought we would take a closer look at this subject. I'm going to start by saying that it's complicated. Gold mining stocks aren't a homogeneous group. So, for example, we could subdivide them into the major producers, the juniors, and the explorers. And even within these subgroups, individual miners will behave very differently. So remember that this analysis is only a generalization. Let's start by looking at the performance of these subgroups that I mentioned earlier. So this is a chart showing the Australian gold major producers. Then this dates back to 1985. And what we can see from this graph is that the index has been very, very volatile, as you can see, going up and down, up and down. And generally, we basically got this sideways movement. And currently, we are at the bottom of the range here. This chart shows the Australian juniors from 1992. And you can see here they've really not fared well compared to the major producers. Again, we're seeing a lot of volatility, but the general direction of movement has been in a downtrend. And since around 2013, you can see that prices pretty much flatlined. And if you thought that looked bad, take a look at this chart, which shows the Australian Explorers Index. And this has been totally crushed over the years, and it's about as close to zero as you can get. So on this index, it's around 4 at the moment. I'd really like to see what these charts look like in the 1970s. So anecdotally, my general impression is that in a big gold bull market, the majors tend to rise first, followed by the juniors, and finally the explorers. I also get the idea that the explorers tend to outperform the juniors, which in turn tend to outperform the majors. And I also suspect that explorers going parabolic would likely signal a top. So how does this all relate to the stock market? Well, this chart shows the S&P 500 in bars, and then we have the HUI miners index shown in blue, and finally we have the gold price shown in orange. And this chart covers the last 20 years. In the early 2000s, we can see that there was actually an inverse correlation between the stock market, which was declining, and the miners and the gold price, which were increasing. However, around 2003 kind of time, that relationship actually flipped. And so all were rising together, and they also all fell together in 2008. Now, interestingly, if we look at that 2008 time, the stock market itself declined 58% in total. That's from peak to trough, whereas the peak to trough gold decline was 34%. And in contrast, the HUI index dropped a whopping 71%. So when the gold miners fall, they fall really hard. But on the flip side, when they rise, they rocket upwards. So if we eyeball this chart, this would suggest that the mining stocks are influenced more by the gold price than the stock market. So let's look at these relationships more objectively. So in the top, in the bars, we can see the HUI index on the monthly scale. And below in orange, this is the correlation coefficient to the gold price. Now, the important thing to note here is that on the monthly scale, the correlation is always positive, meaning that both the miners and gold price moves in the same direction. The correlation is weakest usually when the miners drop in price, but that's not always the case. And if you look at this correlation on the weekly or daily scales, then you do see the occasional dip into a negative correlation, but it's not common and it's usually very short-lived. In blue is the correlation with the S&P 500, and you can see that this is all over the place, spending similar amounts of time in positive and negative territory. So overall, this confirms our idea. The gold price is a far more important driver of the miners than the stock market is. Another way of looking at this relationship is to look at the ratio of those two variables. So this is a chart showing the HUI to S&P 500 ratio on the monthly scale, and this goes back into the late 1990s. And with this chart, downwards movements mean that the stock market is outperforming the miners, whereas an upwards movement shows that the miners are outperforming the stock market. Now, as you can see, we have been at very low levels over the past few years, and the lows that we saw recently are actually something like 1/10 of what the highs were. Now, we don't know how long this is going to go on here, but it's interesting to note that the last time we had such low levels of this ratio was in the early 2000s. So could this be a double bottoming process? This chart shows the ratio of the TSX Gold Index to the S&P 500 on a log scale. And I like this chart because it goes all the way back to the 1920s. Overall, it shows that we have been in a long-term downtrend for the gold miners versus the stock market. Major lows, however, were made in 2001 and in 2015. So how much lower can this ratio go? To me, the downside seems much smaller than the potential upside. Another discussion point that often comes up is the effect of a further stock market decline and deflation. So this chart shows the Dow Jones index in blue during the Great Depression, and this is compared to Homestake mining stock price shown in green and the gold price shown in yellow. Now remember that at that time the gold price was fixed. The first thing to notice is that during that first phase of the crash, there was also a large drop in the price of Homestake mining. This subsequently recovered quite sharply, but then dropped off a little bit and kind of flattened out over here. As the second phase of the crash progressed, you can see that Homestake mining increased in its price, and interestingly, this actually accelerated significantly only when that bottoming process occurred in the stock market. And this is a very fascinating chart that relates the indices to currency in circulation. Now, I'm not very clear on their definition of what they mean by currency in circulation. They say paper money in circulation, but does that relate to M1? I'm not sure, but it is important to know this. Now, they've drawn a line horizontally shown in green at the number 1 value, and when the plot is above the line, then that suggests that the index has risen above increases in the US currency in circulation. Interestingly, the Dow has remained below this line for over 80 years. The blue line shows the Barron's Gold Mining Index to currency in circulation ratio, and this has risen quite steeply on a few occasions, but over the last 30 years has remained below that one level. The red triangles shown here indicate triggering events for bull markets in the Barron's Gold Mining Index. At the time of this first triangle, the Federal Reserve had actually extended a massive $200 million line of credit to the Bank of England and also ignited the Roaring Twenties stock market boom. And as we saw in the previous chart, this triggered an initial rise in the miners, but that only really got going after the stock market had deflated. This second triangle here represents when there were increases in currency in circulation, which started a run on the US gold reserves. And we have this third triangle, which represents Alan Greenspan's reinflation policies after the bursting of the dot-com bubble. Again, we can see that the miners are at historic lows here. So overall, what can we conclude from this? Well, first of all, we know that miners are at historic lows, not only relative to the gold price, but also relative to the stock market and relative to the currency in circulation. So overall, to me, it just seems like the upside is far greater than the downside. So this makes it an asymmetric bet. The other thing is that the gold price seems to be more important in influencing the price of the miners than the general stock market. It's also important to remember that these are very highly volatile stocks, and so although the upside can be huge, so can the downside. The other thing that we've learned is that currency in circulation does matter, and this is particularly relevant in the current situation. So we're going to start this week's market report by first of all discussing my approach to the markets. And I think this will be useful in helping you to see where I'm coming from when I'm discussing the market reports each week. Now, there's no right or wrong approach when it comes to the markets. It's really individual to you and your own personality. But I think it is important to define what your actual approach is. So when people first enter the market, their first response to this question is, oh, I just want to make as much money as I can as fast as possible. But I think you need to look a lot deeper than that and think about what are the things that are important to you and what you don't want. So for me, a central theme is that I like to get a good night's sleep. I don't like stress. And that has really shaped my approach to the markets. As a result of this, I don't short the market and I don't use leverage. Now I know that you can make a load of money through these instruments and strategies, but you can also lose a load. So it's okay for those who have a very high tolerance for risk, but it is very stressful. The problem here is that there's the potential for losing a lot more money than you originally invested, and that would make me lose sleep. And there are lots of examples out there of such things happening. So one example is if you look at the VW chart from Germany back in around 2007 to 2008, that stock absolutely went parabolic. And it totally incinerated those that were short because it happened very rapidly. And a similar thing happened in the Tesla stock recently as well. Another thing that I like to look for is asymmetric risk and reward. So that means things that have what I consider to be a relatively low downside and a potentially large upside. And that's one of the reasons why I quite like the resource sector at the moment. The other thing that I tend to do is tend to look at longer time scales, and I'm quite patient, and as a result my calls do tend to be rather early. And so as a result, sometimes it can take weeks and weeks for my targets to get hit. And sometimes that can be frustrating if you're looking at shorter timescales. So just bear that in mind. And the other thing that I like to do, particularly with things like resource stocks, is those are stocks that have very high volatility and you can get huge gains with those. And so when those stocks double or triple, then it's quite nice to take out the original investment, which means that the remaining stocks are essentially free. And that, I find, takes out a lot of the stress for the subsequent upside. Moving on to the stock market update. In last week's show, we showed this chart, which showed the stock market during the Great Depression. And we talked about this large decline followed by this bear market rally, which appeared to look like a wedge, followed by a subsequent decline. And also we noted this area here of sideways movement, which acted as resistance for the top of that bear market rally. And when we looked at the S&P 500, we've been looking at this for quite a while now, and last week I had said that if price went above the top of these resistance areas here, then I would potentially flip from being bearish to bullish, because there's a lot of air up here. But also remember that there is a small resistance level over here, but it doesn't seem as large as this one that was back in August last year. And of course that 3,000 level was breached and we got to just over 3,068 on the index. But what I didn't realize until after I recorded the show was that actually I wasn't comparing like for like. So the previous chart of the Great Depression was actually of the Dow Jones, not the S&P 500. So if we look at the Dow Jones currently, we can see that that area of resistance is actually much higher up, and we are really barely at the bottom of that area here. So potentially there is more upside here, and it could even go up to the 27,000 level. It just depends on how much of a resistance this is going to present. Let's have a closer look by comparing these two side by side. So this first chart is from 1930 and the current chart is from the current time, 2020. So if we look at the initial drop from peak to trough, that dropped 48% in 2 months, whereas the recent drop was 38%, but this was much faster in 40 days. What about the rise from the bottom, or the so-called bear market rally? Well, in 1930, this rose 48%, but it took 5 months for that to do so. Whereas currently, so far, we've only had a 41% rise, and that's taken 67 days. So what we can deduce from this is that the timescales do seem to be compressed in the current day. The other thing that I've learnt is that I had drawn the wedge in far too early. And so sometimes you actually have to wait for patterns to form before you can confirm what's actually going on prospectively. And so here it actually seems like the wedge actually starts from over here, as it did back in 1930, rather than the very bottom of the drop. So where are we in this wedge compared to where we were in 1930? Well, I think we're probably around this kind of area, in which case we've probably got a little bit further to go. How long that's going to take, I don't know. It could be a few weeks. And as I said in the earlier chart, just like it did in 1930, where it just popped out the top before it dropped, this could go as high as the 27,000 level before it drops down. Now, of course, all of that assumes that we are in the same pattern that we were in 1930. But I must say that I have seen this kind of pattern quite a few times in a lot of different types of stocks and assets. And so that's why I'm still very suspicious of this and do have that bearish outlook. Now, of course, there is that question of manipulation and stimulus, which is thought to be driving this move up. So what happened back in 1930? Well, we do know that the banks did get together and they actually bought stocks at higher than market rates to try and encourage confidence from the public to get back in and buy stocks. And certainly over this time, there was increasing optimism. And in Wall Street, I know that over Christmas time, so that was around here, they were having lavish parties and enjoying themselves. And the retailers were also piling in and basically had renewed confidence. So stimulus did occur during that time. However, the level of stimulus was limited because they were limited by the gold standard. Of course, here we don't have that limitation, and the big question is this current level of stimulus enough to keep this going up? My view is that we're going to need a lot more than has currently been put in. What I'm wondering is that we've had this stimulus. This may lead to a little bit of tapering of stimulus by the Federal Reserve in terms of liquidity provision and so on. And then as a result, this might drop off, and then you could get further stimulus to try and pump things up again. So basically, I think we're going to need much bigger bailouts in the future. And what has been done so far probably isn't going to be enough, but who knows? There could be lots of other factors at play, such as short squeezing and so on. Let's see what happens. Nobody really knows. Let's move on to gold, priced in US dollars on the monthly scale. I'm looking at the monthly scale for a lot of the charts today, just because we've reached the end of the month, and it's always good to step back and have an overview of what's going on. So a few people have mentioned whether we've got the possibility of a cup and handle due to this rounded appearance of the chart pattern here. And that's certainly a possibility. If I would say that the cup lip would start over here, and then the right lip, it's hard to know whether we've actually completed it. This is pretty close to the left lip, so let's see, it could still go up higher to the 1800s, but it doesn't have to form the cup. Now, the big question is, are we going to form a handle? We don't actually have to, it's not a requirement, and price could actually go straight through. If it does decide to form a handle, then usually the handle will be quite shallow, and I've looked up generally how deep these handles go, and it's generally a third of the way down the cup, and that would bring us to around the 1500 US dollar level. Sometimes they can go as far as 50%, but I think if we were to come back to these previous highs here, I think that would be a little bit too deep for that handle. And the handle can form in different ways. So one possibility is if we had a channel like this. Another possibility is that we could get a pennant formation, and that would drive price upwards. And then another possibility is a falling wedge. So in the coming weeks, we'd want to look out for any of these if a handle is going to form. And if indeed this pattern is correct, then we'd be looking at a price target of just over 2,500 US dollars. Now, of course, remember, we can't know for sure whether we are looking at that pattern when we're looking prospectively. It's only in retrospect when these things become obvious. And a quick look at gold priced in US dollars on the daily scale. And previously we'd spoken about this symmetrical triangle. Price had broken out, but then gone back to retest the top of that triangle, and subsequently actually went down to retest the bottom of that triangle. But then price subsequently reversed again. Interestingly, this candle here shows a long wick, and it never really closed below that top trend line. So was this a fake out to shake people out? Notice that we didn't make any lower lows, and this top channel line here that we drew a long time ago still seems to be holding as support. Since we are currently in an uptrend, we must continue to assume that price will move upwards, and given that we've got this pattern, the target would be 1,800 US dollars. However, remember that we are in an area of entanglement due to that area of support and resistance that occurred in around 2012. The other thing to remember is that there is a potential that we may start to form a handle at some point, in which case price may well go back into that channel before making its next move up. It's very, very difficult to tell what's going to occur here. Moving on to silver in US dollars on the monthly scale. And here we have this long-standing red upsloping trend line that we drew in last year, and that had held pretty well for quite some time. And at one point I did mention that I didn't expect a break of it. However, silver does like to mess with you. And what happened was that we did see a break of that line, but then it sprung straight back. So that may be a little fake breakout there. And prices bounced up nicely up to 1785, but you can see here that there is quite a bit of resistance here, which may affect further moves. So I'm wondering whether we're going to get some consolidation between this red and this upper black line. Any break of that upper black line, which is at around the $19.30 kind of level, that would be hugely bullish, because there's a huge air pocket from there up until the $28 area, where you've got a fair amount of resistance coming in there. Could price break down to below that red line? Well, it's possible, but I think it would be stopped at this lower black channel line, which is in the mid $11 range. And I don't think it will stay there for very long if it did get there. But more likely, I think we're going to be within this channel range in the coming weeks, really, until we get a breakout. And finally, let's have a look at the miners. So this is the GDX chart on the monthly scale. And recently we had this important breakout from this horizontal channel trading range. And this was a 7-year level of resistance formed by a gap which was present on the daily and weekly scales over here. We've had some stunning price action recently with this massive decline, which rapidly bounced back up and actually surprised a lot of people in breaching this resistance level. Now, although I don't trade the GDX, I had purchased some individual miners when the GDX was in the lower half of this channel, and so that's why I'm not overly keen on rushing in to buy more at this stage unless it goes back into that channel. I'm already pretty happy with my gains. Now, in terms of upside, there does seem to be a fair amount of resistance over here and here, so at around the 40 level. So what happens here does partly depend on what happens to gold. If gold steams up towards 1800, then I think it's entirely possible for this to go up to the 40 level. And at that point, there is a chance that it will be resisted and bounce back a little bit. Alternatively, if gold does form that handle before it reaches the $1,800 level, then a break back into this channel is a possibility. If we look at the daily scale, we can see that price has been moving up in this nice channel, and this black horizontal line shows the long-standing resistance and what is now seems to be support at the 32 level. So the thing that supports upward movement is that this 32 level is likely to be relatively strong support given the history. It's already acted as support over here and over here. The things that would support downside movement, however, are, first of all, we've broken this upwards channel lines. The next thing is that we've got gaps lower down. And the other thing is that volumes have been decreasing with this increase in the miners. So those are things that would make me nervous of some downside. But don't get me wrong, I don't think it's going to be a devastating downside. If we get that handle in the gold price, then the downside may not even reach the lower half of the channel. So the lower half of the channel is anything below 16. This could only potentially go as far as 24 before it makes its next move. Again, it's very difficult to tell at this stage. The other thing that I would say though is that if we do dip back down into this channel, any upward move is likely to be pretty strong in that this resistance is probably not going to be particularly important. It will probably just slice through that. So that's it from me for this week. Don't forget to like and subscribe, and we'll see you next week. Bye.